Now, I wanted to bring that up too because this is a comment from last week's end of webinar survey. When you leave the webinar or when the webinar ends, a survey will come up. What did you think of the presentation? Did you have any questions regarding the materials discussed? What would you like to see in a future presentation? We had one from last week from JDan. JDan says, right now, I'm doing mostly Iron Condors. I also like to get more acquainted with the long put and call strategies and how to find better candidates. I know there's plenty of videos in the past. I just need to find the time to research them. One more. It's getting harder to find decent premiums with the VIX down where it is. Any advice going forward? All right. Well, let's start from the beginning. Let's change our screens over to the YouTube channel, as I mentioned. There we go. All right. So here we are looking at some of the recent content I had just discussed, of course. And we're in the video section of the PowerOptions YouTube channel. Let's just click on playlists. And you see a variety of our different playlists. And then we have call buying and long calls. And I haven't put together a full one yet on the puts, but it's going to be very similar. Some of them are lumped in together. There's going to be more direct ones for puts, JDan. But here's a great place to start. More acquainted with long put and long call strategies and how to find better candidates. Here's a basic one. Tools for evaluating long options, 9 minutes and 32 seconds. This one's a bit longer because there's a lot there. A look at searching for long calls, married puts, full put credits, and more. Is there a proper delta to buy a call? This presentation is going to help you with the delta discussion, but also help you with other criteria and what to expect. And I think even a look at the long option finder, where the best delta to buy also depends on the expected movement of the stock. If you're expecting a 10, 12% movement, you probably want maybe a 0.4 or 0.3 delta, slightly out of the money, less cost, to take more advantage of that large movement. If you're concerned that you're only going to see maybe a 4, 5, or 3% movement, you might want to be deeper in the money. You might want a 0.6, 0.65, maybe even a 0.7 delta. Might not see as a higher return. But if you're going with the lower delta, with the lower price, hoping for a bigger return, you see a smaller move, remember, you could lose 100% on that long call as you get closer to expiration. When to expect a profit, call spreads versus long calls, just some strategy comparison. Long call or spread, 8 ways to manage a profitable long call. Ideas for managing a losing long call. Using the stock repair tool as well, and managing a bought call that is near full loss. So a couple of these videos, especially the tools for evaluating, will cover not only the search, criteria, ideas, review the default criteria for long calls, but also some of the other tools I mentioned, such as that long option finder, which can help you, identify which call or put would theoretically give you the best profit if a stock hit your expected target price on your expected target date. So here's a good place to start, JDan, in relation to the long calls. And of course, as always, if you have other questions about search criteria, setting up the search, you have direct questions about the long call, long put, or any strategy, send us an email at any time, call the office during market hours, or schedule one of those free coaching sessions, which is essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. All right, now let's go to Power Options to address the second portion of your question. For those of you that are subscribers or those of you that are on a trial or been on a trial, let us know your thoughts. Right now we're running the 6-month survey, I should call it, the biannual survey here. So you can just click on it and take the survey. It's just 2 quick questions, I believe, 3, I think, but 2 or 3 quick questions. What would you rate us on a scale? Would you recommend us to a friend or a colleague, I believe is the actual question. What improvements would you like to see? And do you have any other feedback? So there's just a couple forms to fill out there. It won't take long at all. Now, the second part of JDan's question was related to the Iron Condor positions. And now with VIX down, premiums are harder to find. Well, let's take a look first at the VIX itself. Let's pull up the chart for the VIX. This is a 3-month chart for the Volatility Index. You see today, we're pretty much near the 52-week low. The VIX closed today at 1672. The low of the 52 weeks was 1617, which was hit 3 days ago. I can remember, and I know you can too, those of you that have been trading back a few years ago before all the madness of some of the hecticness of 2018 leading into what we know happened in 2020, vicious 2022. For a couple years before that, the VIX was hanging around at 9, 10, 11. Numbers such as 29, 30, 31 hadn't been seen for years. But again, here we are. And just in the last month or so, we saw peaks almost up to 31. So we're almost at half, a little bit less, but we're almost at 50% of where we were from the peak just about a month and a half ago. And let's see, what's the date there? That's the, March. Yeah, March 13th, 9th, and 10th. 13th. Okay, I got to jot that down. March 13th. But really, the higher closes was right in there. That would be March 15th. Oh, sorry, folks. March 15th and 17th. Okay. So just a little over a month ago. Now, how is this going to affect credit spreads, Iron Condors, covered calls even, using the same criteria? I want a good range out of the money. I want that high probability of the stock being between my strike prices, criteria we'd look for in the Iron Condor structure. Even if I've been using the same search for the last 2 years, and you might have had some headaches with the market movement in the last years doing a neutral strategy such as an Iron Condor, but you were seeing good premiums. Now they're going to be maybe a third less than they were with the exact same criteria, maybe more, but we're going to see how bad it is. Let's just go to the home page of the Iron Condor. What is this Iron Condor structure? The Iron Condor is a neutral options trading strategy that generates a credit. By neutral, we mean we don't want the stock to move. We're essentially entering into two credit spreads. A bull put credit spread, where we're selling an out-of-the-money put and buying a further out-of-the-money put for protection. But at the same time, we're going to do a bear call credit spread, selling an out-of-the-money call and buying a further out-of-the-money call to control the monetary risk between the positions. Usually want the stock price to be right in the middle of our sold put and our sold call. Naturally, you can see the issue. If the stock falls too much, we're going to start losing on the bull put side. If the stock has a large movement upwards, we're going to start losing on the bear call side. But it's a leveraged position. It generates a credit. It's a popular strategy to use on indexes as well as more secure and stable stocks. But there's a trade-off. Those are going to have a lower volatility compared to trying to do a credit spread or an Iron Condor, say on Tesla or something more volatile. Let's take a look at the search. Now, as always, for every strategy, we have default searches that you can use as a stepping stone to create your own search. I'm sorry, this is from a previous webinar, our 0 DTE test. Let's just go with the initial value screen for the time being. Okay, so we've got Netflix for a 28-day trade. This is the monthly screen. We do have the weekly screen there too, but this is a monthly screen. Looking at an 18.9% return. CrowdStrike, Snowflake, these might even be considered a little bit more volatile. But again, a 28-day out trade. Let's take a look at the Netflix position. This is not a recommendation or suggestion, but it is based on our default criteria. Before I do that, what is our default criteria? We're screening for Iron Condors specifically on a monthly one for this default search, 28 days out in time for the standard May expiration. We're looking for a return of at least 10% of the margin requirement, the difference in the strike prices of the call or put spread minus the net credit. Want a minimum net credit of 75 cents. What is this maximum risk? Well, we're telling the system we don't want to see a strike difference of more than 20 points, that the monetary risk, the difference in the strike prices has to be less than 20. And we want to be at least 10% out of the money for the short put on the bull put side and the short call as well. We're minimizing some basic long bid-ask spreads, and at the same time, we're using the probabilities, which are related to delta in a sense, but we're looking for a probability between the theoretical probability that on expiration 28 days away, based on the past movement of the stock, that it will remain between the two strike prices, the sold put and the sold call, meaning all 4 options would expire worthless. We'd keep the net credit and have the full return on the position. But we're also looking for a probability above the short put break-even price and the short call break-even price of 75% or higher. And just some really basic option volume and some open interest as well for the sold option, the sold call, to see some activity. You can change that any way you want. That's just for the options. In the technicals, we're keeping the beta less than 1.25. Why? And of course, the beta is the movement of the stock over the last X amount of days in relation to the movement of the S&P 500 index. This is a neutral strategy. We don't want something extraordinarily volatile and that's been moving all over the place, up and down, whether on news, whether from a recent earnings, whether anything like that. We want a calm and stable stock. I know the market hasn't been calm and stable for some time, but we're seeing the VIX drop, so the fear gauge. And what is the percent bandwidth? Well, we'll take a look at that when we go back to the stock chart, but this is based on the Bollinger Bands. We don't want to see a wide Bollinger Band range between the upper and lower Bollinger Band. We want that to be less than 50%, where the stock's currently trading within a 50% range of the upper and lower band, so there's not too wide of a bubble off of a recent move or recent volatility. This is screening particularly just against stocks, and we're looking for higher price stocks with a better premium, stocks above $50, which also means we want to avoid earnings between now and expiration. We don't want any surprises that might come back to haunt us. And to avoid some other leveraged concerns, we're taking out the leveraged ETFs, the Ultra 2X and 3X on this basic screen. So again, first, let's take a look at that Netflix profit and loss chart. Some things I may or may not change, but it looks like this graph is okay, so we're going to stick with it. One of the filters I could use, of course, is to limit or restrict what's called the percent out of money range. Doesn't mean how far the short call and the short put is for being out of the money. We know we're at least 10% out of the money because that's what the search told the system to find. But a percent OTM range of, let's say, 45 to 60% means you're targeting stocks that are currently trading right in the middle of the two strike prices. Some investors will skew an Iron Condor. They're bullish on the stock. They still want to do the Iron Condor trade. So the stock price might be trading here, and they're entering, I'm sorry, bearish. This would be bearish. The stock's trading here, and they sell it closer to at the money short call to get a higher premium on the bear call side because their expectation is the stock's going to fall. That allows them to go deeper out of the money on the put side. Personally, in that case, if I have that outlook, I just do the bear call credit spread and try not to double dip with a directional Iron Condor. Reverse skew, obviously, as I started to mention but did wrong. If I was bullish on the stock, I might skew it towards the short put, have the short put be only 3 or 4% out of the money, where the call is maybe 10 or 12% out of the money, because my expectation is the stock would move up in price. But in any case, I want it to be as close to equidistant as possible. I want the stock price to be as close as equidistant to the short call in the short put, percent out of money range 45 to 50%. As long as it stays between those two prices, all 4 options expire worthless. We keep our net credit of 79.5 at midpoint for that 18.9% return against the risk of 420. Now, we didn't review the actual strikes. We should do that. Let's take a look here. Spread that was found with Netflix trading at 327, let's call it 328. We're going to sell the 285 put, more than 10% out of the money, and buy a 280 put 5 points apart. At the same time, we're going to sell the 365 put. So we're about 37 points out of the money in both directions, a little bit less, but 37 points out of the money to the upside, and buying the 370 call, 5 points apart. Now, your broker knows that you can typically only lose on one side of the trade or the other. So even though both spreads have a 5-point strike difference, you only have to cover typically one side or the other. I don't have to put up 10 points to cover the two different spreads. You can see the advantage or the benefit if you're just getting introduced to Iron Condors today. We're double dipping on two credit spreads with keeping the same 5-point margin requirement, and that gives us the strong return of 18.9%. Very quickly, let's take a look at the stock chart for Netflix. We know earnings are not coming up between now and expiration. We know our targets, we're at 365 for 30 days away. And our lower was 285. So it's kind of structured in this range. Now we've seen some wide bubbles here. This is the Bollinger Band. This is our upper Bollinger Band, and this is our lower Bollinger Band. In the middle, in between, is the SMA 20. But right now, we had a condensing here, but it sort of broke out of that. We saw a bigger bubble, but now we're going back into sort of a condensing stage. Maybe I'd want to see a little bit more of a prolonged condensing stage for the Iron Condor structure. That's personal preference. But we are getting back into that range. We're still relatively, well, yeah, we're at a point, 365 on the sold call, where the stock was above a couple of months ago, about 2 months ago, but it hasn't breached below 285 in the past 3 months. So it looks like two pretty good target ranges for the position. But that's just what the Bollinger Bands were. I wanted to explain that because we saw that we were using that Bollinger Band range of less than 50%. All right. So that's now 10% out of the money, 28 day out spreads, roughly, on our search, probabilities, of 75 above the upper and lower break even. What are those? Those are these marks here. So even though we know that my price, we took about 80 cents in net credit, we're selling the 285 put, but with about 80 cents, the break even at expiration is 284.20, 80 cents below short put strike price. Upper break even is 365.80, 80 cents above based on the net credit of the short call that we sold. So that's just what we wanted to set that. There's a 75% probability that stock would be above 284.20, my apologies, in the next 25 days, and a 75% probability that the stock will be below 365.80 in the next 28 days, and an 80% or higher chance, it's actually, sorry, let's go back to the results. My probability, 81.7% theoretical probability based on the past movement of the stock that Netflix will end between the short call and short put strike prices. Now, one thing that you can do on a trial, and you can do a lot more if you're a subscriber to PowerOptions on the historical level of service, is we can go back in time using that same criteria in the backtesting tools to see how things performed, or what results we might have seen with the same exact search criteria. Let's go to backtest, and we're going to go to the Smart History Excel. And we're going to go back to March 15th or March 17th. Let's start with March 17th, when we saw the VIX up at that peak of around 30 or 31. Really, it closed a little bit lower. It looked like maybe 29, 28 or so. But during that day, the 15th, 16th, and 17th, I should just use the 17th as it was expiration and St. Patrick's Day, so let's do that. And let's grab our initial values default screen. Let's go ahead and submit that. Now, what this tool is doing is exactly what it's expecting. It's taking that exact same criteria that we just saw in the search function. It's going back to March 17th and evaluating which Iron Condors would have matched that criteria that we used based on the closing prices of March 17th. Now, it does take a little while to do this right now, just at this time at 5 o'clock during the webinars that we're hosting. And the reason why is right now we're uploading all of the data for the historical value for today's close. Now, this isn't too extreme. We're going to do a touch-up in just a moment, but we're seeing almost the same prices for 28 to 35 days out, aren't we? We know we're using the same criteria. But here we're seeing 21% returns, 19% returns, 18.8% returns with the same probability. We're seeing different stocks. I don't see Netflix in here, but hey, CrowdStrike is still in there. That was one of the ones that was on the current search. Snowflake still in there as well. I don't see Netflix here. That's okay. So, but there's a lot. What else are we seeing here that backs up what JDan is saying? There were 398 results on March 17th that matched that minimum 10% return, with those probabilities we were looking for being 10% out of the money. Higher volatility, you had more choices. 398 would have matched the default criteria. We just saw 5. So there's still positions out there that match your criteria. There's still positions out there that are going to find the return. You just don't have as many choices, JDan, in those cases. How can your concern? It's harder to find decent premiums. The decent premiums are still there. And as you can see, using the PowerOptions search tool, you can find those 4, 5, or 6 positions. If you're using a criteria that's been working for you and you're not seeing the returns that you want anymore, my suggestion is you might have to go a little bit less out of the money. If your filter was looking for a 10 or 15% out of the money range for the short call or the short put, you might consider trying to drop that down to maybe 7 or 8% if you still want to target the credit, premium, and specific return that you want. You do want to target the specific return. Some investors focus more on just the net credit. I have some investors who trade the credit spreads that, yeah, they want an 80% probability. The return in their mind isn't much of a concern. What they're focused on is they want at least $1 premium for a 72 or 75% probability or higher. Whereas I tend to personally not focus on the monetary value of the credit spread. I focus on the percentage return. When I'm doing the bear call credits, I'm usually looking for something around the 14 to 15% range. With my select criteria. So it doesn't matter to me if it's a 2-point spread, a 4-point spread, if it's a 40-cent net credit or 30-cent. I'm focused on the return personal, more than the hard net credit in that situation. But change your out of the money range. Have the expectation that returns are going to be lower if the VIX stays down in these ranges or continues to drop further. But that also means there may be a good opportunity for more consistency with the Iron Condor strategy we've seen in the past few years, as there's less fear in the market and less things moving against you in those scenarios. One more thing I'm just curious about, why not? I just want to calculate the group results here. So once you've run your search, you can see the returns, the positions that would have matched the criteria on the back test, in this case from St. Patrick's Day, March 17th, with our default Iron Condor screen. And this was today's expiration, the 21st of April. So I click on calculate. You can view the return of each individual one by analyzing position or price history. Analyze position is the best view to use. But calculating the group results is going to take your top 30 results here and show how they performed to expiration. I'm actually kind of scared to look at this. Nice. Wow. Okay. So 29 out of 29 from that search on March 17th would have expired worthless using the default criteria, average return of 15.3%, about what I target, slightly lower, just the bull put credit spread, with mild movement. Well, we know there was movement over that time, but sort of mild settling, QQQ up 3.6% over that 1 month and 4-day time period, SPX up 5.2% over that time period. So all of the stocks ended between the strike prices of the initial search. This is not telling me if any of them breached what you would have used as a trigger. You know, if one of them actually broke down below the short put or the short call strike price, it doesn't allow you to set alerts. But as I mentioned, you can analyze the individual position. Let's just take the Adobe one. It was the 285, 290 bull put spread and the 400, 405. And stock was at 358.14, ended at 377.67. Analyze position. I'm going to go back to this screen here for the Adobe position. Yeah, it was 35 days out. And let's see. The minimum return was 10.9% on 331. My apologies. 331. We're down 10.9%. Oh, so this graph is showing my return. I'm sorry, folks. My return versus movements in SPX and QQQ. But down below, we've got the stock price. And on 3/31, the stock price was at 385.37. So no, it wouldn't have hit my 1% rule. It wouldn't have hit 396. It might have intraday because I'm just seeing closing prices, but 385.15, 385.37. The position was down 10.9%. But again, doesn't look like it breached the upper or lower value at any time during that trade. The lowest value it hit was 361.70. Oh, sorry, it was open date 358, and it moved up. It got close. But when I do these trades, Iron Condor credit spreads, I usually follow that 1% rule. If the stock reaches within 1% of the short option strike price. In this case, it didn't. So I wouldn't have to worry about a trigger. Might have had a little sweating here on 331 and 405, but I probably wouldn't have managed it as it didn't hit my 50% loss limit, didn't hit within the 1% rule of my short call or short put strike price, and the position would have been profitable. So some of these other ones might have hit that mark, but we're not going to go through all of them. So I hope that answers your question related to your approach, JDan, meaning that, yes, now that the VIX has been dropping, now that the VIX is down to near lower levels, we might have to consider adjusting some criteria. If I still want a minimum 17% return with the Iron Condors, we're still getting a 75% probability of $1 net credit. Now you're not seeing any results with that search criteria. You may want to consider making some adjustments. You may want to decrease the range out of the money. You may want to decrease the expected return. The safest thing to do, in my opinion, is to have the lower expectation right now and decrease the percent return. You know that the range out of the money and the probability that you've been using has been working for you. That might not be something you want to change, even in the slower markets. That's the conservative approach, is to focus on the return, lower the expected return, lower the expected net credit. But if you feel comfortable that the VIX is going to stay low for a while, that the market is calmed down, all these fears that we've had going on, or maybe we're just, the market itself is just turning a blind eye to the fears that we've seen, maybe you could lower your probability range, your delta range, or the range out of the money. But to me, that's the more aggressive approach to finding positions that match still the criteria you want. But that is a way to go. That is a way to do it. All right. And you can just use the search tool to adjust that. And of course, as always, remember, if you have questions about this after you see the presentation, go ahead and send me an email, give me a call, or schedule one of these free coaching sessions for trial members and for subscribers as well. And we can talk more about that. Now, in addition to that, I just want to change the screen real quick to mention something else. Our buddy Kip sent me something today, talking about the VIX and talking about everything else related to the volatility index, the $ VIX on PowerOptions. Kip sent me an email with an article and with some other points in it and discussions on it, but here's some thoughts. Here's what's happening. Next week, the CBOE is going to launch a one-day VIX. It will give market watchers a fuller picture of the risks involved. So we're going to start to see the 0 days to expiration trading on VIX, as we've seen with SPX and some of the other indexes as well. So that's just something to consider as the popularity has grown, and this thought here that will give the market watchers a much fuller picture of the risks in the equity market on a day-to-day basis rather than based on the 20 to 30 day out, 37 day out futures values for the VIX. This is giving a more day-to-day valuation of the fear gauge in the market. The CBOE is releasing that next week. So we might do a better discussion on that when we see more of the information that comes out and when it starts trading next week. I did look at 1 or 2 articles. I could have asked Kip for more articles, but I was working on some other stuff today and I didn't want to get pulled down that rabbit hole just yet. We're going to see how it comes out. We're going to see the more information about it, but starting next week, we're going to see that one-day VIX that will give us the daily view of the fear gauge as opposed to based on the VIX futures out in time. So we'll have some ideas on that and some concepts on that, and I'm sure I'll have to go through and test some strategies based on that. Maybe make some adjustments to some strategies or strategy testing based on that. We'll have to see, but just something to keep in mind.